Hello, and welcome back to another edition of Jack, You Got This. I'm Peter Van Brady, your host and founder of SoCal VA Homes and author, excuse me, of the book Avoiding Mistakes and Crushing Your Deals. Pretty popular on Amazon, but you can get it on our website, socalvahomes.org, for free. Simply go to Intel and Resources and scroll down to the book, and here we are, veterans helping veterans using easier, better ways to buy using your VA loan. And today, we are going to talk about CalVet versus VA. So let's jump right in, shall we? All righty. Okay, we'll take this guy out of the picture for the moment. All right, so CalVet versus your VA loan, which is better? So let's start with credit scores. Credit is obviously a really important thing in this universe, and some things happen to some people. They're not always good, and that affects their credit. Where CalVet really shines are lower credit scores and very flexible underwriting. These are really the reason to consider CalVet, because they have no minimum credit score. And if you have something that happened in your life and you're rebounding from it, there's a story there. And with CalVet and manual underwriting, they only do manual underwriting. That's real humans looking at your documentation, trying to make an intelligent, make sense decision. If you've got a story to tell, myself or one of our senior VA loan professionals or somewhere out there in the marketplace that works with CalVet indirectly or directly can help you tell that story and help get that approved. So these are the reasons to consider CalVet: flexible underwriting and lower credit scores. Whereas in my opinion, the industry accommodating really low credit scores is not so good with regard to your VA loan here. So that's a reason to consider CalVet. Let's go down to debt ratios. So maximum debt ratios with CalVet are 41%, with some exceptions, and that is that's because it's conservative, old school underwriting, and that's real humans trying to make sense decisions. Whereas using desktop originator, desktop underwriter, loan prospector, these are fancy names for automated underwriting engines that are the industry standard in the business of approving not only VA loans, but conventional and FHA loans as well. And with an approve eligible status, you can go really high on your debt ratios. That means you can qualify for much higher loan amounts, provided your lender will accommodate higher debt ratios, all the way up to 60, 65%. Debt ratios are your principal, interest, tax, and insurance. That's your new mortgage payment with taxes and insurance, plus your car loans and credit cards and whatnot, divided by your gross income. So all your obligations over and divided by your gross income. That's probably the most important underwriting metric, filter, element, consideration point when approving VA loans or CalVet loans. And VA will definitely let you go much higher. And that's a huge advantage. With regards to entitlement, both CalVet and VA are using your VA entitlement. Yet with your CalVet loan, they have a CalVet 97 with a small down payment. That does not encumber your VA loan benefit or loan benefit entitlement. Let's talk about interest rates. This is where CalVet tends to, unfortunately, well, they just don't shine in this arena. This is going to take me some demonstration here. Let's take a look. Why doesn't CalVet shine? First of all, let's compare current rates and then go back to a chart. Alrighty, so let's take a look at today's CalVet rates. Here we have 2.9%, 2.875%. You think, oh, those aren't bad rates. Well, comparatively speaking, they're not appealing at all. And let me show you why. So compare those to this rate right here, 2.25%, or all of these rates here, 2.25 to 2.625. I'm going to get back to this in a moment, but the reason CalVet does not shine in this arena is because we are in a declining interest rate market. And CalVet, rather than go into the details, they issue bonds, and they issue them infrequently, once or twice a year. And those bonds have a coupon rate or an interest rate. And that interest rate is designed to deliver the investor a particular yield. So they issue these bonds, they collect all this money and lend it back out to you. And those are at a set rate, and it doesn't change. Whereas the market literally changes daily, or sometimes more than once a day. So CalVet might be a good bet when you're, say, right here, okay? I'm sorry, CalVet might be a good bet back here, a good option for you in say September of 17 through July of 18, when market rates have gone up, but let's say CalVet issued their coupon in this area and still has a lower rate that they're delivering relative to market rates, which have been rising. But when the reverse is true, and rates have now been falling for nearly 2 years, CalVet is issuing at these coupon rates that are higher as long as rates keep declining. And again, rates have been declining, so you see these higher CalVet rates in the high twos, yet current market rates in the low twos. So in my opinion, really, in a declining interest rate market, especially in this environment, CalVet is at a disadvantage, and I rate it as average, where a VA loan from any company that specializes in VA loans, such as ourselves, you are going to usually get an excellent rate. With regard to loan limits, there are limits with CalVet loans, yet as of January 1st, 2020, there are no loan limits thanks to the Blue Water Navy bill. We can get more into the actual loan limits and conforming loan limits later, but the bottom line is VA is going to shine because there are no loan limits. Although the CalVet loan limits are really high, and most people aren't interested in buying, $900,000 or $1 million homes with no money down, but it can still be done in excess into the millions with VA. So VA gets it there because the no limits, that's an advantage. Loan locks. Now this is interesting. Just as an aside, most people won't show you this stuff, but I'm going to show you right now. Pretty cool right here. These are loan lock days across the top. With this particular investor, they're focusing on short-term loan locks of 8 days, 11 days, 22 days. Yet with CalVet, there literally aren't any terms with the loan lock because they've already issued that bond, and they just have to basically exhaust those funds before they issue a new set of bond or a new bond to investors at their current market rate. So they're rated as excellent with regard to loan locks, whereas the lenders that specialize or offer VA loans, lender by lender, are average because as you go out in time, so to speak, with these loan locks, you can see from 8 days, these prices change. That 2775 is actually a better price than the 248, and we'll get back to that in a moment. So I would definitely say that CalVet is going to shine in terms of loan locks. Now, here's really where the balance beam tilts, and it This is where CalVet does not shine. CalVet charges a loan origination fee of 1% on every transaction. A loan origination fee is not required on a VA loan. And CalVet does not offer any lender credits. What's a lender credit? Well, there's closing costs in every transaction. You've got title and escrow fees and all the other fees. And then in CalVet, you've also got a loan origination fee of 1%, which is required. And that's not the case with a VA loan. So if you don't have much money to close, which is not uncommon in our universe of clientele, you've got to figure out who's going to pay the closing costs. Will it be the lender? Will it be the seller? Will it be the real estate agents who never want to pay it? So it's really got to be the lender or the seller. And in an environment where lender credits are available, that's going to be a big help. And let me again go back to this, what we call a rate sheet, and it's an industry language for products that we're offering in the marketplace. There are no lender credits with CalVet, but there are lender credits available with VA lenders. So again, opening up the kimono and kind of looking inside, here's the way this works. So if we move the interest rate from 2.25 up to say 2.625, you can see this negative number. That's what we call a secondary market premium. No one will ever talk about this in the business. I'm happy to. And that means what the loan is worth to us on a base price before adding in all sorts of credit score, debits and credits and incentives and all sorts of other things, which ultimately arrive at the sale price and finally value of a loan. But the point is, when you go from 2.25% up to 2.625%, you get an increase of a lender credit. This is money that's paid to the originating company. It goes from 1.7% to 2.7%. And the bottom line is that can be super valuable. So when the loan literally goes, there's always, let me back up, there's always a range of interest rates available from the very lowest interest rate, which tends to require discount points, and all the way to the highest end of the interest rate spectrum. This might be a full percent, between say 2% to 3%. And so as you move from that low end of the interest rate spectrum all the way to the high end of the interest rate spectrum, typically, depending on the environment and the loan program, a lender is willing to contribute lender credits into escrow to offset those closing costs. And that is huge. That can be the make or break element as it relates to the economics of getting a transaction done. So that's it. In my opinion, CalVet really shines in the lower credit score and flexible underwriting arena, where when it comes to loan pricing, CalVet is a disadvantage because of that 1% origination and the inability to offer lender credits, of which the marketplace for VA loans is very, very successful in that capacity. Okay, we'll see you next time. Thanks for joining us. I look forward to talking to you soon.